Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Ceat. Should you buy this stock at these levels or one should avoid it? So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Ceat, here's a small request that kindly support me on Patreon, and once you do that, help me grow the channel, help you also ask me questions and eke out answers in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts I put out from time to time. And also, you can pay $100 upfront to get 1 year access by paying for 10 months. So that's a 16% discount. For detailed market or company talk, you can directly email me and we can work things out with a fee. And also, if you cannot pay on Patreon, you can take the monthly membership on YouTube or on WhatsApp. Now, the company established in 1958 in Turin, Italy. Its official name is KV Elettrici Affini Torino, and one of the biggest tire manufacturer, Ceat, manufactures for passenger as well as commercial vehicles and two-wheelers. The market cap of the company has grown to 4,600 crores, and over the last couple of weeks, it has gone up. It has exports operations to multiple locations across the globe. About the financials, the sales went up by around 9% in the third quarter, whereas the profit dipped. So, from a profit of 130 crore, the company went into losses, and primarily due to owing to higher oil prices compared to last year. There was a lot of expenses on Ceat. Lower cost helped numbers on the bottom line. Otherwise, it would have been even worse. But the cost was from the raw material. So lower cost was because of the lower taxes that they would have to pay this time around. Otherwise, there was escalation of raw material, you can say, cost that were coming in. ROE of around 12%, operating profit margin of 10% is quite decent but not extraordinary for the industry. MRF has been doing much better in this field. If you look at the performance, stock has declined over the past few months, and demand has been shallow, especially during the pandemic. Demand went down sharply, and if you understand that work from home culture has meant that there was lower transportation of, you can say, products, even of vehicles and personal vehicles. The return ratios are extremely average, and there is a decent dividend that the company pays out, but over the last 2 3 years it has struggled to produce very good numbers. And with the raw material cost going to be staying high for the next 2 3 quarters, it looks difficult that the numbers would come back pretty soon. In terms of the analysis, higher crude may sustain, so $100 to $120 per barrel will not help Ceat in any way. It is one of the greater, you can say, raw material that goes into making of tires. Global economic growth is still having headwinds, and we are seeing that happening in US and Europe as well as here in India. Yes, there are chances that higher inflation is taking place, but that doesn't mean that economic growth is getting better. I think we could be in a situation of in a very inflationary environment, and in that I don't see many of the manufacturers passing on the higher raw material cost or higher cost directly to the consumer. So that's where the margins are going to be hit. I think higher raw material cost and inflation, to keep a bottom line in check, margins will be hit big time. But stock has already declined a lot, so that there lies the dilemma. So it may remain range bound, may give you those 8-10% move. That is what is happening. So the stock went to around 900 levels and have recovered from those levels, but it won't be a stock that would consistently go up and may hit new highs. In terms of technicals, currently it is trading at 18-19 times earnings. The major support lies around 900-920 levels, and it went all the way down to 750-780 as well. So if things go bad, I think we could be headed towards 800, but I think around 900 one can accumulate. Those are good levels to buy. Again, I say that the stock is down big time. It's down more than 50% from all-time high. So I don't see a lot of capitulation in the stock, but I don't see a lot of of you can say up move over the next 1 year. Major breakout is expected above 1080 levels. It looks extremely weak on long term charts, and it may remain under pressure even going forward. So there will be a lot of investors who would be looking to probably booking out and taking positions into other sectors whenever an up move begins in Ceat. So in my opinion, this is an avoid at current levels, and we can look at other sectors, especially export-oriented service sectors, for the next 2-3 quarters at least. I think this inflationary pressure will hit bottom line of many companies going forward. So look for strong up moves to exit and have only 5% position into such stocks. So this is my video on Ceat. Please like and subscribe my channel and hit the bell icon so you get my videos straight away when I post it, and kindly support me on Patreon. Thanks a lot for watching.